I'm Peter White. Welcome to the Inside Network. Welcome to another edition of INDepth. I'm Peter White. My guest today is Sebastian Evans, Managing Director of NAOS Asset Management. That's NAOS for NAOS. Seb, welcome.
Yeah, thank you for the opportunity.
An unusual name, but having said that, you're pretty low profile, probably under a lot of people's radar. Can you tell us a bit of background on the firm?
Yeah, so I've been here my whole working career. So this is my 15th year, so straight out of uni basically into NAOS. And as you said, I think we've been under the radar for as long as we can remember.
You were formed in 2013, is that correct?
Yeah, 2013 is when we first launched our first lick. So we were around before then. But I suppose how we got here today, I think if I could summarise it, I'd say we're clearly very niche in what we do. So we operate in the smallest end of the market in a very concentrated manner.
Small and micro caps.
Yeah, small and micro caps. But I think relative to our peers, we own 30% of a business that's only capped at 20 million. So there's very few, if anyone out there that can replicate what we do or dares to replicate it. And I suppose because of that, we've built a name for ourselves that, if people are looking for micro cap exposure in a concentrated way, they look for a firm like us. And our long-term performance has been solid. And over that time, we've been able to bring on a few more shareholders. We only started with 400. So to get it to 8,000 means we're doing something right.
And what's your FUM today?
It's roughly 400 million, all in listed investment companies.
What are the greatest learnings through the growth that you've had?
I think falling in love with your own investments and your own beliefs is a big one. I think if you're a bit naive, you tend to believe your own skill, and I think that as soon as that happens, that's probably the start of the downfall. So I think it's very important to listen to everyone's view and do a lot of fact checking. And the other one is just to admit that you're not an expert in everything. Keep it simple. You don't have to be in the next buy now, pay later stock. You can invest in ordinary, simple businesses and still do very well.
Well, the founder-led theme is very strong in your business.
Yes.
Across all your funds. Can you talk to me a bit about that?
Yeah, I think it definitely originates from NAOS itself. So, I remember when I was with Rob, we didn't have an office and we got kicked out of someone else's office, and we were rolling down our computers and chairs down Pitt Street one day to move into someone else's boardroom. And I think that mentality is what we look for in any business. I think with a founder, you have someone who hopefully is very aligned, very financially aware, but most importantly, makes the best long-term decision for a business. I think, ever since I've been in the industry, you see more and more businesses that are listed, they're so short-term focused. There's so much pressure to meet consensus expectations for the next 3 or 6 months or 12 months. And there's not really any awareness of the ramifications of what that may do for a business in 5 years' time. With information so freely available and so quick to come to our screens or our phones, there's a lot of pressure for, I suppose, instant gratification. And I think that worries me.
Do you think that'll ever change, or is it just locked in?
I think it will change. I'm a believer. I'm a bit of a diehard. So I think it will, because I think at some stage when things do normalise, if you take a normalisation of interest rates even and just a normalisation of risk globally, people will see that a lot of these businesses that have made these short-term decisions hasn't necessarily been for the benefit of the business over the longer term. And I think, as Warren Buffett says, when the tide goes out, you'll really see who's left standing, as opposed to some businesses that probably just won't make it. But it's been such a long time since we've been through something like that. I think people tend to have very short memories.
But your general outlook is 5 to 7 years,
yes.
Is it not?
Yes, it is. And I think I'm probably shaped by the fact that my career started 3 years before the GFC. So you could argue maybe I'm a little bit scarred by that. But I think the thing that becomes very important to me is going through the GFC, you really need to be in businesses that could ultimately survive and fund themselves through the GFC, because everyone remembers that they couldn't get funding, they couldn't get debt, they couldn't get equity. So it was imperative to invest in a business that had a very strong balance sheet. Albeit today, that sort of strategy probably hasn't paid off as much because capital's so freely available, and I suppose the amount of capital being thrown at the economy by the governments around the globe allows businesses to survive for such a long period of time.
How difficult is it to convince investors to take that medium-term view of 5 years plus?
Look, I think it definitely is difficult. I think everyone wants the next 20 to 30 to 40% return every year, especially when things are good. But But I think there's definitely an element of people, and I also find there to be people who are self-made, who run small businesses. They're very much willing to take a longer term view because they've done that themselves. They understand what that feels like and what the requirements are and what the outcome is. So they are out there. There's definitely an element of people who want very short-term returns and want to be the next sort of millionaire from Bitcoin or whatever it may be.
Can we talk about your new fund being launched in October, the NAOS Private Opportunities Fund?
Yep.
Just tell me a little bit about that. Why, how, and where?
Well, I think it probably takes me back to 2013 when we launched our first LIC. We really put ourselves out there by saying we're going to start a microcap LIC that focuses on very small stocks in a very highly concentrated manner. And a lot of people were probably taken back by that and perceived it to be too risky. Fast forward to where we are today, I think we've come to the realisation that equity markets are very competitive. As you would know, there's plenty of fund managers out there, albeit not so many in our space. But I think we've realised that if we really want to take this business to the next level and really offer our investors something that's truly different and truly beneficial for them, I think private markets is really the way to go. And the reason is I believe that more and more businesses will remain private for a lot longer as opposed to becoming public.
Why?
I think, myriad of reasons. But I think, first of all, businesses who don't require capital generally probably won't list. In my view, businesses list for two reasons. They need capital because they're capital-hungry businesses, so financial businesses, or they're loss-making, or unfortunately, the founder or the owner is looking to reduce their stake substantially. And for us, they're not great reasons to be investing in it.
They're looking for liquidity.
Yeah, exactly. So we're looking for businesses that are private, and I can relate to this myself because I've raised money 3 or 4 times in the manager that's unlisted, and I want to partner with people who understand what I'm doing, and they're willing to give me growth capital, and they trust me and our strategy, but they can also add value, and that's what we're looking to do for other private businesses. And there are thousands of them out there, and a lot of them, especially in the smaller space, don't know where to look if they require equity or debt. They think they can only go to a bank. They don't realise there are other places to go for capital.
Do you see this private market expanding?
Yeah, without a doubt. We're definitely not here to do one fund. I think we're here to prove the model, and that's why we're being very careful about it. But there's no reason that we don't believe that the private side of our business can be as large as the listed side of our business.
Are there any particular sectors that you're targeting?
We definitely won't invest in certain things. So I think we're not here to be the next venture capital firm. I mean, there are thousands of them out there who are much more intelligent when it comes to venture capital investing. We're looking for proven businesses that have revenue of at least $5 million, that have, I suppose, they've proved the model, they have a competitive advantage, but they really want to scale. And to do that, they probably need capital. But it can be, as I said before, it can be a boring business. It could be something in regards to building materials, it can be industrial, manufacturing, which is making a huge comeback. There's a lot of innovative businesses out there that don't have to be technology-based. And that's what we're looking for, albeit very founder-led businesses.
Do you ever envisage investing in a business that has a track record, say, of 1 or 2 years?
I think definitely the only way we would bend the rule, in regards to the example you gave, is if it's someone we knew well who'd come out of a larger business or another listed business and was starting a new, I suppose, venture, and they needed capital to start that venture. I think that's the only reason you would look to deploy capital in a very early stage business, because I think I've found a lot of it is about people. It's about people you can trust, who are transparent. So if we can find those people and provide them with capital, we'd be stupid to say no.
But generally, it's people with a track record.
Yeah, without a doubt. Yeah,
rather than an idea.
Yeah, exactly, because you don't know these people, so you need to look at some, I suppose, form of reference that they do know what they're doing, and they have made, I suppose, excellent returns over 5, 10, 15 years or whatever it may be.
How hard is it to find the investment opportunities, put that capital to work?
Yeah, it's a good question. I think we're apprehensive, but over the last 6 months, we've been putting our feelers out. And to be honest, we've been inundated with opportunities. But I think the one thing that separates that, and I suppose the disclaimer we should use, is there's a lot of low quality opportunities out there. And I think by low quality for us, that's very early stage. So there's lots of early stage businesses looking for capital today that are pre-revenue or have very low revenue. But when you're looking for businesses that have revenue and have grown it from a reasonable amount over 1, 2, 3, 4 years, they're much harder to find. But the one thing we have found is when we do find them, we tend to find quite like-minded people. So they're looking to partner with someone who understands their business and wants to come along for a journey. They're not just looking to partner with someone that can give them a check, walk away, or give them a hard time for the next 5 years and just look for an exit. So I think that's quite interesting for us, because already we've found that we're resonating with 2 or 3 very interesting investments. One which hasn't taken any outside capital for I think 15 years, and it's quite a well-known business. And they just want like-minded people. It's not just about the money. So for us, we think we're quite optimistic that we can find some really exciting investments over the next few years.
How many total investments do you expect to have in this fund?
Yeah, so again, we're sticking to our motto, and it's going to be concentrated, and we're only thinking of making anywhere between 7 to 9 investments, we think. It definitely won't be a scattergun approach. We're big believers in transparency and partnering with people and helping them, as well as, I suppose, they'll be helping us. And we feel that's where we get our most leverage and our competitive advantage relative to our peers.
Are there any sectors or types of people or types of businesses that you're going to avoid, you won't invest in?
So anything that's related to gaming, casinos, even mining, coal mining is an obvious one that's been very topical lately. Things like that we won't touch. We're really looking for businesses that, as I said, are quite simple and businesses that we can relate to. But in regards to things that we won't touch, it'd be anything with an ESG screen that fails to meet the tests, and anything that's just really too small, proof of concept, really very early in nature. We won't go near either. And also because that's such a competitive market.
But some people won't invest in financials and cyclicals like resources, but that's...
Yeah, so we won't do resources, but when it comes to cyclicals, like industrial cyclicals, don't have an issue with it at all. We think there's some great... You look at businesses like Reece, which is the one we pulled out. I know Reece is very popular today, the plumbing business. But 20 years ago, very few people knew about it. And that was essentially self-funded, up until maybe 2 years ago when they moved into the US. That's a fantastic family story of building a very big, profitable business, albeit it did list.
What sort of levels of return, if I'm an investor in your fund, would I could expect or hope for?
I think in the documents we've said a return of at least 16% per annum, or an internal rate of return. That's what we're targeting. Obviously, we want to target something much higher than that, considering the risk that we're taking. We're well aware of the risk. But to be honest, it's very early. But, we're seeking substantial returns, and I think very substantial in regards to what we expect in the listed space as well.
Sebastian, thanks for talking to us today, and good luck with the fund.
Yeah, thank you very much.